Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. We have a big week ahead of us, so let's jump in. And first up, this story is related to both Asia and the United States. SoftBank founder Masayoshi Son has proposed a bold initiative to establish a joint US-Japan sovereign wealth fund aimed at catalyzing large-scale investments in technology and infrastructure across the United States. This ambitious concept, though not yet formalized, has been broached at high levels in both Washington and Tokyo, including direct discussions between Son and US Treasury Secretary Scott Bessent. According to sources speaking to several outlets, including the UK-based Financial Times and US-based Wall Street Journal, the envisioned fund would be co-owned and operated by the US Treasury and Japan's Ministry of Finance, each holding a significant stake. The structure would be designed to welcome additional limited partners, potentially offering ordinary Americans and Japanese citizens the opportunity to invest. Insiders suggest the fund would need to be quote, enormous, end quote, to achieve its goals, with an initial capitalization potentially around $300 billion, supplemented by significant leverage. The joint fund proposal has gained traction as trade talks between the Trump administration and Japanese negotiators continue, with both sides seeking breakthroughs. Japan is reportedly pushing for zero tariffs, while the US insists on maintaining a baseline tariff of at least 10%. A recent call between US President Donald Trump and Japanese Prime Minister Shigeru Ishiba hinted at progress, with Ishiba indicating that a planned G7 summit meeting in Canada in mid-June could mark a milestone in negotiations. For the US, the appeal of the proposed fund lies in its potential to generate substantial revenue streams without raising taxes, a consideration increasingly pressing for the Treasury. Quote, however far out this joint fund may sound, it would in theory provide that, end quote, said a person briefed on the discussions, speaking to the Financial Times. The proposal is seen as a potential blueprint for a new, quote, sovereign-to-sovereign financial architecture, end quote, that could replace ad hoc policies and deliver consistent returns. From Japan's perspective, the fund could provide a, quote, properly governed covenant, end quote, that shields Japanese interests from unpredictable US political decisions, particularly those emanating from the Oval Office. Historically, US strategies have relied on offering tax incentives to attract direct foreign investment. This approach contrasts with the proposed fund, which would directly deliver profits proportional to each government's investment. Masayoshi Son's involvement has been pivotal. Known for his high-stakes investment and close ties to Trump, Son previously announced the $500 billion Stargate plan, partnering with OpenAI and Oracle to build data centers and AI infrastructure in the United States. This type of project, aligned with the proposed fund's vision, could attract significant investment. Son's proximity to Trump, highlighted by his prominent visit to Mar-a-Lago in December, positions him as a key figure in the evolving dialogue. While the joint sovereign wealth fund remains in the conceptual phase, its potential to reshape investment frameworks between the US and Japan and its broader geopolitical implications could become a defining element of future trade and economic strategies. With the upcoming G7 summit poised as a pivotal moment, stakeholders will be watching closely to see if this ambitious proposal moves closer to reality. Next up, we move to North America, but we're going to head north of the border this time and talk about Canada. Canada's economy appears to be entering the early stages of a recession, driven by rising unemployment, falling exports, and an escalating trade dispute with the United States. Things are not looking too good. According to a US-based Bloomberg survey of 34 economists conducted between the 16th and the 21st of May, the country's output is projected to shrink by 1% on an annualized basis in the second quarter and contract slightly by 0.1% in the third, a technical recession. The trade war with the United States, Canada's largest trading partner, has taken a toll on key sectors. Exports are forecast to decline by 7.4% in the second quarter after US importers rushed shipments forward earlier in the year to avoid looming tariffs. While analysts expect a modest recovery in exports later in 2025, The damage to labour markets and household consumption is already evident. Unemployment is predicted to rise to 7.2% in the second half of 2025 before easing next year. Meanwhile, inflation is set to hover above the Bank of Canada's 2% target, with rates of 2.1% in Q3 and 2.2% in Q4. The central bank faces a difficult policy environment, with Bloomberg's world interest rate probability indicating less than a 30% chance of an interest rate move in June. The Bank of Canada governor underscored the need for greater clarity on the US trade relationship, expressing late last week, quote, "The more we get uncertainty down, the more we can be forward-looking in our monetary policy decisions," end quote. The housing market has also slowed amid this uncertainty, with economists projecting weaker housing starts in the second half of 2025. Prime Minister Mark Carney hopes for progress when he meets US President Donald Trump at the G7 summit in Alberta next month. However, Carney has acknowledged that the era of deep Canada-US economic integration may be drawing to a close. Despite the challenges, forecasters still expect Canadian GDP to grow by 1.2% in 2025 and 1% in 2026, reflecting cautious optimism for some muted recovery. But a lot could still happen between now and then, as we very much now live in interesting times. And if you want to be on top of the most up-to-date analysis on global markets as we move through these uncertain and very interesting times, make sure you're subscribed to Market Update. Hit the bell notification icon and you will be. 70% of regular viewers are not subscribed. It's just a click of the mouse, but it's a tremendous help for the channel, and it means you will not miss anything. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. And finally for today, we now move to Europe. US President Donald Trump has agreed to delay his planned 50% tariffs on European Union imports until the 9th of July, following a phone conversation on yesterday, with European Commission President Ursula von der Leyen. The move offers a temporary pause in escalating transatlantic trade tensions, which we unpacked in Saturday's video, and signals a possible breakthrough in stalled negotiations. Quote, "She said she wants to go down to serious negotiation," end quote. Trump told reporters after the call, adding, quote, "We had a very nice call. She said we will rapidly get together and see if we can work something out," end quote. Von der Leyen confirmed the conversation in a statement, describing it as a, quote, "good call," end quote, and emphasizing the EU's readiness to advance trade talks, quote, "swiftly and decisively," end quote. However, she noted the bloc would need the full 90-day negotiation window initially agreed upon to finalize a deal. The call marked the first publicly disclosed conversation between Trump and von der Leyen since he came to office. It came just 2 days after Trump's surprise threat to impose steep tariffs from the 1st of June, a move that sent shockwaves through European capitals and threatened to deepen the transatlantic trade war. Trump's initial 20% tariff threat in April had triggered a 90-day negotiation period set to end on the 9th of July. On social media, von der Leyen underscored that, quote, "Europe is ready to advance talks swiftly and decisively," end quote, but also reaffirmed the EU's need for the agreed timeline. Her office confirmed that she initiated the contacts, signaling a potential shift in Brussels' approach. However, on Friday, her chief trade negotiator, Maros Sefcovic, cautioned that the EU would, quote, "defend our interests," end quote, and called for, quote, "mutual respect, not threats," end quote. Stephen Moore, an economic advisor to Trump, called von der Leyen's statement, quote, "a promising sign," end quote, that the EU was ready to negotiate, adding, quote, "It may not be as rapidly as Trump would like, but I think this is a peace offering," end quote. Both sides acknowledge the talks have made little progress, with long-standing disputes over tariffs and the EU's services surplus with the US continuing to cause friction. Should negotiations falter, the EU has prepared a €21 billion tariff package targeting US goods, including maize, wheat, motorcycles and clothing, and is weighing an additional €95 billion list of potential targets. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for a new update tomorrow.